Thanks so much for tuning into today's Talking Point. I'm your host, Neeraj Shah. Our guest today is Sanjay Mookim of JP Morgan. Sanjay, always a pleasure talking to you. Thanks for taking the time out.
Pleasure being on, Neeraj. Good to be here.
Yeah, thank you. Sanjay, good rally. No one can complain if you are an equities fan. The last few days, we've seen some turn in that yields have inched up a little bit. Crude prices are heading higher for the last 2-3 weeks. FI flows at the margin last 3-4 days have been slightly wobbly. Have we run up quite a bit? And relative to the markets, could we therefore see some corrective moves, stroke consolidation? What is your view?
Strategist, a question like that, Neeraj, you're going to get a macro answer. Now, what we think has happened globally is the re-injection of liquidity in the middle of March, actually precisely the 13th of March, in response to the small bank crisis, the SVB crisis as it's called in the US. And this has immediately had an impact on equity prices. All markets have rallied other than for China starting the 13th of March. And historically, if you look at the correlation of liquidity to market performance, it's very strong. From 2008 to now, equity markets, MSCI World, has moved almost entirely in line with the size of balance sheets of the big four central banks. Now, of course, it's great to say this in hindsight, but on the 13th of March, as more liquidity was injected, markets have rallied. Now what is happening, Neeraj, is that you're starting to see central bank balance sheets start to contract again. And markets have so far, the last few weeks, defied that contraction and have stayed elevated, which is a very significant disconnect that we highlighted in a research note last week, arguing that if liquidity continues to now withdraw, which is the plan, then equity prices everywhere will come under pressure, and that will have an impact on Indian equity markets as well.
Interesting. So you reckon that everything else is an entourage to the main event, which is liquidity, and liquidity being where it could be, as you're saying, there is a higher probability of a corrective move world over, and India would participate.
Yes, exactly right. And there are nuances to it. What within it will correct more, what will correct less. So, for example, we think the growthy stocks will correct more than the more value stocks, and you may get value outperformance here on. But the starting point is that we've seen this rally in the last few months fueled by liquidity, which has led to multiple expansion. So if you see the performance of stocks, Neeraj, it's not been because we've seen earnings upgrades. The entire rally, almost entirely, like I say, is being driven by higher valuation, which is a phenomena of better liquidity. So as that liquidity turns, it will put pressure on Indian equity markets as well.
Okay, there is, I presume, no scientific way of correctly predicting these turns that as they happen. I mean, you saw it on 13th of March. I don't know if you were able to predict it. And please correct me if I'm wrong here. And part two, is there a way to predict as to, by and large, for how long would this withdrawal stay and for what reasons?
So that is a challenge for all of us. When you're living through an event, it becomes very difficult to anticipate the next path, right? For example, on the 13th of March, when the Fed said, okay, look, we're injecting liquidity to bail out or save the small banks, we didn't really know how long that might last, what the size of that liquidity injection might potentially be, what the uptake from banking system might be. But in hindsight, it's easier to comment on it. Now we know that once that rescue package has been absorbed, that the Fed is back to its QT. It's back to tapering, back to withdrawing $80, $90, $100 billion a month. And that is also predictable. At least we don't see a reason for liquidity to start coming back positively into the market again. So assuming that Fed sticks to plan on QT, liquidity will continue to tighten here on, which, like I say, should be a difficult environment for all asset classes, really.
Got it. In which case, Sanjay, would this run correction stroke consolidation largely revolve around what the Fed and the other central banks do, or could Indian markets have a slight disconnect in that because the domestic flows continue to remain strong?
Irrespective of the domestic flows, Neeraj, if you look at 25-year history in the country, decoupling of Indian equities has happened maybe 2 or 3 times, and that has required significant events to happen. So let's say big election surprises or the COVID reopening. Those are the few instances where India has temporarily disconnected or decoupled, as people use, from the global equity sentiment. We don't see such an event in the next 6 to 9 months? I mean, yes, we are heading into elections, but that probably increases uncertainty. So if you then ask for decoupling, you probably see a downward decoupling if elections become a topic of conversation in India to begin with. So we're not saying that India should underperform EM. There is no concerns to that extent as well in the next 6 to 9 months, but it is unlikely that we'll decouple to the upside as well if global equities were to come under pressure.
Got it. The other aspect, Sanjay, is the favor that growth markets like India might have had better valuations. Now, my question is, assuming that the scenario that we're talking about stays true for the rest of the year, but if the world markets and consequently Indian markets correct slightly sharply, let's say 5-10% happen in a period of 1-2 months, do you reckon that even if the liquidity withdrawal scenario stays in place, India-specific flows, which some of your peers that we've been talking to are saying are starting to come very, very strongly, could India-centric flows start coming in at those lower valuations and give support?
The sentiment for India amongst EM fund managers is super strong, and it is likely to remain that way, because if you take a dispassionate view of the structural growth of EM economies, let's say for the next 5, 10, or 15 years, then India is probably the only major country where you can argue for steady structural growth. Most other economies are either too commodity driven or have headwinds of too medium term growth, and therefore the bias for investors always in India should remain positive, right? To say, look, if I can find something at a good valuation, at a good entry point, and I have patient capital, then I am positive India. And we've also at our end done a lot of research demonstrating confidence in that structural growth potential of the economy. And the problem here is that we keep arguing that markets don't necessarily always discount structural growth. There is cyclicality to markets, because if we didn't, then I wouldn't really be here. I wouldn't really have a job. And markets are more cyclical than that structural element might justify. And therefore, we argue both things. That cyclically, you could see a correction, and that might create opportunities for people who have patient capital to then add a little bit more aggressively to India, and wait for the 3-5 year compounding to come into play.
Okay, so before we get to what looks good, I heard you start off this conversation with this thing that within this whole construct, there's a nuance of what will withstand the pressure, what will lead the correction. Can you tell us with your rationale as to what both of these sides, if I can use that term, would be?
As a style, growth stocks, high duration stocks, companies which are expected to deliver high growth for the next few years, those are the stocks which have re-rated more than the market globally and in India. So if you look at, let's say, March to now, it's consumer discretionary, NBFC, mid-cap, which are all considered the growthy basket, which have done well, And therefore, that correlation with global styles to Indian equities has also played through. So if this thesis is right, that withdrawal of liquidity would pressure on markets, then growth as a style comes under pressure. And the three baskets that come top of mind, like I said, discretionary, NBFCs, which have done very well in the last few months, and mid-caps, again, as a basket, which have all re-rated. I mean, they haven't seen the earnings expansion yet. This is what comes under pressure, to my mind, in the coming months.
Got it. Now, within that, there could be a nuance, Sanjay, in that as basket-wide, we may not have seen too much of an earnings expansion. But within that, there are pockets which are seeing very large order flows, strong earnings momentum even in Q1 or Q4 of last year as well. And the commentary around what growth could be is very strong. There is power, there is railways, to an extent, the book-to-bills of the defense names, etc., are all looking very, very strong. Some of it is B2G, some of it is not. Now, I would love to understand, what do you think withstands the pressure despite maybe higher valuations, because the earnings are looking strong and the commentary is not that bad either?
Before I answer that question, let me talk about the framework of stock picking that we've employed successfully for the last several years, Neeraj, which is not growth. If you're a 12-month investor, and most of people who stay in the markets, I mean, when they talk structural, have evaluation periods of 12 months or less. So if you're a shorter term investor, then it is earnings revisions earnings surprises that determine stock return, not earnings growth. We've done a lot of quant work running correlation statistics to establish this fact. And therefore, and this is where the market has this strange sort of outcome, that while we're seeing good outcomes in quarterly numbers, and we're seeing companies come out and say, look, growth is strong, we're not getting earnings revisions, positive earnings revisions, because expectations are still very elevated. Right? So what I need to do is to figure out not just where companies are doing well, but companies which are doing better than what is already forecast by analysts or the market in a way. And in that sort of framework, there are actually very few stocks that qualify. Very few stocks or sectors where we can argue, Neeraj, that you will get significant or notable earnings upgrades in the coming few quarters. In fact, like I said, if you look at the, let's say, Nifty mid-cap basket post the March quarter, and March again had this tone of things are recovering and things are doing well from company management, most of them actually had their FY24 EPS cut after results, even though the numbers were supposedly very strong. So there is this dual phase that, look, companies are doing better, tone is improving, but expectations are already more than pricing it in, which is the problem.
Okay, so here's my question, Sanjay. If your clients are coming to you after reading this note and asking you where is it that they should get off the train currently, because even if it's a structurally good story, tactically there might be better opportunities later, or otherwise that, it's run its course and therefore it's bad. What do you think fits that bill? What will lead the downside?
What we've been arguing, Neeraj, is that the financial sector companies, which are very consensus, banks, big, large private banks, they have struggled on valuations. Multiples for everything has come off in the last several quarters, despite steady growth and earnings upgrades. And there could be a variety of reasons why those multiples have come under pressure. The more the divergence I see in the large private banks from growth versus valuation, the more tempted I am to continue my recommendation on staying overweight private banks. Right? And you can select which ones you want. And unfortunately, I can't name stocks on our TV channel, but that is the space that we have been very positive, saying, look, we're getting growth, low earnings cuts, or actually earnings upgrades still, and multiples look interesting. What is the trigger for the switch from the growthy, discretionary NBFC stuff to, let's say, performance of more structural growth companies? I think it will have to be pressure on global equities. There is nothing internal, nothing domestic, nothing happening in Indian markets that will cause a switch by itself.
Okay. And since growth stocks, as you mentioned twice in this interaction already, are the ones which might actually correct, I'm guessing that would mean most things discretionary, because some of them have had a really good run because of this higher consumer spend theory or no new capacities coming on stream theory, etc. So all of those would probably come off. Even the platform companies, we have a few of them now in India, have had a good run. You reckon those could also come back, so to say?
They fit the growth style, and they have seen very sharp rally exactly at the time that this global equity rally has started, and the reversal of the style will put pressure on all those stocks as well.
Got it. Sanjay, idiosyncratic. There are some spaces in which the announcements are looking very strong from the government side and the private companies as well. Power, for example, quite turning the corner, if you will, or maybe has turned the corner. I don't know how you're looking at it, but would love to understand specifically about this particular sector, because we're seeing continuous announcements of large capex, large order flows, and very positive commentaries from the companies.
We think this will continue, Neeraj. This is the start, I would argue, of a multi-year required capex in power sector. Now, what is happening is, because of the reforms and initiatives that have been taken, the receivables situation in at power companies or distributing companies has improved significantly. And we get this data, almost real time nowadays. State-wise payables has fallen almost 50% on a YOY basis and will likely remain contained. And therefore, the health of cash flows for people in the industry is much more assured than it was previously. At the same time, demand growth for electricity is improving. And there could be a variety of reasons that demand growth was subdued for a few years and is now simply normalizing. So as demand supply in power sector tightens and you see better cash flow, the ability of companies to invest, create more power capacity, is much better than before. So we expect that over the next 2 to 3 years, you should start to see continued power capex in India. The challenge that you have, Neeraj, is it too early? Am I jumping the gun a bit? And which stocks benefit from power capex? Those are the debates that you have with investors. But the underlying theme of a revival of power capex, I think, is very convincing.
Got it. The other aspect which I picked up from a few of your peers is that the incremental news flow for the rest of the year for IT might not be as bad, because we've heard everything that could be bad already, and maybe some of it is discounted as well. Do you share the view, or is your view slightly different on IT?
How do you establish that it is discounted or not? Okay. Is it in the EPS forecasts? Have people priced in any potential weakness? For most companies, I would say not, Neeraj, because people are still expecting relatively decent growth in top line and bottom line. And so going back to my framework, do I expect those expectations to be missed or beaten? The bias is to say they will be missed, right? If you take the results that we have seen in the June quarter, and then you look at what is implied for the next 9 months, it looks very aggressive. So it is certainly not discounted in earnings projections for this sector. Is it part of valuations? Again, you will not be very confident in saying that, because for most IT companies, the valuations are above where they were in 2019. And relative to market also, they appear to be at a slight premium than they used to be. So while it may be easy to say, oh, it's discounted because the stocks have fallen, it doesn't appear to be part of earnings. The weakness doesn't appear to be part of earnings projections, neither in multiples, and therefore we are convincingly underweight that sector for now.
Got it. Sanjay, my last question, because we have that much time, but my last question, you've spoken about the overarching factor, which is the withdrawal of liquidity as being the key determinant for the next 6 to 9 months, maybe, or until the Fed changes its tune, as the case may be. What are the other things that you are very keenly watching out for in addition to this, which may enable you to, if not change your thesis completely, then at least be less or more sanguine about the reversal in fortunes for the Indian indices?
If you mean for something to start going up, it will have to be earnings. And the hope there, Neeraj, is that the consumer steps back to the plate. And what we expect to happen in FY24 is this handover from COVID-led government stimulus to consumer or corporate spending, which sustains growth in the economy. So unless you see that handover happen properly, and we know that government capex is going to slow as percentage of GDP, it has to, because deficits have to be brought down. So unless that consumer spending picks up, corporate spending picks up, you may get a patch of slight soft activity levels in the economy. So the hope is that the consumer steps back. The prima facie conditions are there. So inflation is falling, jobs seem to be coming back, consumer confidence is improving. The outcomes in company results are still very mixed. So it is still more in the hope territory rather than the actual outcome territory for now. But if you started to see signs of a strong consumer revival, then you could possibly look for a broader set of ideas within the equity market.
Just extend that. Sorry, one last question, and which is, could the decks be set for that? In that there is G20 as well as the Cricket World Cup happening in the current year. There is a very busy second half with what I hear in one of the con calls, 30 to 40% more wedding dates in the country this year relative to the second half of the last year. So are the decks set for that to happen? If we needed enablers, are the enablers there?
We'll see, because what you've pointed to are very narrow service sector phenomena. What I need to do well is the mass discretionary categories, where I think canary in the coal mines will be, which will be, let's say, the footwear, the apparel, the electricals, the durables, which have been disappointingly weak for a while. That's what needs to turn to my mind, not the hotels and airlines, which have been doing well for quite a while. So the health of the consumer, I think, will be assessed by the mass consumer categories, mass discretionary categories, in fact, which I think the jury's still out on that, Neeraj.
Okay. Still a hope trade. Let's see if it shapes up. But Sanjay, thanks for really putting it out as to what the macro looks like and how India could participate in that. Really appreciate you sharing all those details with us.
Pleasure being on, Neeraj.